Okay, so the mortgage industry or the home buying industry is going through a lot right now. It's insane. Interest rates are the highest it's been historically. Property prices, although showing some signs of cooling off, it's still relatively expensive compared to what it's been historically. So a lot of people are wondering or are confused or just flat right anxious on what to do. Should I go ahead and buy right now because we don't know what the rates are going to be tomorrow? Or should I just go ahead and wait and just put our, keep our fingers crossed that rates will go down? Hello, my name is Dayo Webb and welcome to my channel. My goal is to help simplify the mortgage buying process so that way you can make a more informed decision on buying your home. You know, they say knowledge is power. On this channel, my goal is to share a lot of knowledge to help simplify the process. So let's get on with the video. So the truth of the matter is, if I'm to be honest, there really isn't any right or wrong answer to the question. But I do want to break or share 4 things that I think you need to consider when you are in that process to make a decision. If you are at the end of your lease, when say you're renting, you're at the end of your lease, and you don't know if you just go ahead and buy or if you go ahead and renew your lease. Okay. So your finances, right? We all know that whenever you're buying a house, it's a huge ticket item, and that comes with a lot of out-of-pocket expenses. 2 of those are your down payment and your closing costs. So down payment, typically you can range from 3% all the way out to 20%, right? Or even more. But your lender will probably be able to figure out what works best for you. But say, for instance, your lender says your down payment, they can get you into a program that allows you to put 3% down. All right. And you've shopped around, you found a house. The house is priced at $100,000. Wishful thinking. I know you probably can't find that in this market. Bear with me. This is just an example. But if your down payment is 3%, your purchase price of the house that you're trying to buy is $100,000. If you do the math, 3% of $100,000 is $3,000. Your down payment in this example is $3,000. Now you have to pay what we call closing costs, right? Closing costs could range up to an additional 3%. So in this example, closing cost is $3,000. So if you took your down payment and your closing costs, your total out-of-pocket expenses is $6,000. So after you've paid $6,000, how much money do you have left in your bank? Do you have enough money saved still to cover 6 months of housing expenses as an emergency fund? They say usually 3 to 6 months. But if you don't have at least 3 months worth saved of housing expenses, then you're not ready to buy. I would recommend wait a few months, save a little bit more money to where you have that additional saved for a rainy day. So if you're not in that, if you don't have that, then probably it's best for you to wait. Number 2, your credit score. In today's market, your credit score is everything. The higher your score, the more competitive you are in getting the best mortgage program and the best interest rate. If you are not at a 700 score, I would recommend wait. Work with a reputable credit repair agency, work with a loan officer, and they can make recommendations on things you can do to help you increase your score. But let's think about it for a second, right? So you go to a lender, your score is at 580. We can get you a loan. Don't worry about it. We can get you a loan. Now, you're all excited that you found someone that can approve your loan, but that approval is on is going to cost you a huge expense in your rate. So your published rate, when you see lenders that post 5.99% interest rate, those rates are typically for people that have the best credit scores. They have a lot more money down, because the more money you put down, the higher you put down in a down payment, the higher your credit score is, the less risky your loan is viewed as, okay? And the best rate you'll get, right? So if you're not putting a lot more, if you're not putting money down, or at best, if you don't have or at least if you don't have a high credit score in the 700 range, then you're going to be paying a pretty penny for that loan. So my recommendation is, if you're not at that 700 credit score, I would recommend wait, okay? You may need to sign a 6-month lease if you're renting, or even a 1-year lease if you're renting, to work with a reputable credit repair agency to help you get that score up. There are lots of things, there are creative ways out right now that you can implement to help you boost your score. Now, if you don't have a credit repair agency, slide in my DM. I have people I could recommend you that can hold your hands through the process. If you want to do it yourself, but you don't know where to start, slide in my DM and I can make recommendations and share letters that I've used that has helped me, get my score to the next level. The third thing I want you to think about is how long you're going to plan to live in that property. So say your score is where it needs to be, you have the down payment, you have the extra saved in reserves for emergency funds. How long are you going to be staying in this house? Are you staying in this house for a year to 2 years? If that's the case, wait. Okay, I'm just being honest, wait. The reason why I say that is because when you buy a house, I just broke down on the low side of how much it will cost you to buy a $100,000 house, at least $6,000. You still have other closing costs that you have to, there are other out-of-pocket expenses that you'd have to worry about. But at the very least, you have to come up with $6,000 to get that $100,000 house. And if you're going to live in that house for just 1 year or 2 years, then you wouldn't have broken even, right? It's best to just wait. Wait to figure out what's going on in your finances, or figure out where you want to live, and then make that decision to buy. All right, so we've talked about 3 things that you need to consider to make a more informed decision should you buy or rent. If you're getting value out of this video, please, please, please smash that like button, share with your friends, subscribe to the channel, so that way I can bring valuable content to you such as this. All right, so let's get on with it. So the next thing I'm going to talk about are the pros and cons of buying a house versus the pros and cons of renting a house. So the first thing is, and I'm going to be looking at my notes. So the first thing is the pro of buying. One of the biggest things are your tax deductions. So whenever you own a house, you can deduct your mortgage interest. You can also deduct your property taxes. Versus if you're renting, which would be a con when you're renting, your rent is what your rent is. You can't really deduct your rent on your taxes. So the biggest one is, well, not the biggest, one of the biggest one is your tax deductions. The next one is equity. If you are a current homeowner as of today, then you are benefiting from the equity that you've built over the years in your home. Property prices is the highest it's been in a long time. Although we're showing a little bit of slowing down or a little bit of cooling off, but it's still relatively high compared to what it's been, say, 5-10 years ago, right? So if you've bought your house, say 5 years ago, or even a year ago, if you've bought your house even a year ago, you've seen your property value increase substantially. That increase in property value is called equity. Equity is also known as wealth. So whenever you buy a property and you start to make your mortgage payment and you're paying your payment on time, you are building equity in your home. Now people can say, well, interest rates is going up, people aren't buying as much, so there's going to be a decline. Or if you're on YouTube, you're seeing everybody sharing videos about crash here, there's a bubble and the bubble is about to burst, there's going to be a housing crash. In my opinion, I disagree because we still have a supply issue. So even though there's a slight slowing down in people buying, we still have supply issues. People aren't listing their houses as fast as they used to historically. There are not a lot of listings in the market. That's another video. I really don't want to go through that rabbit hole. But because we still have a supply issue, we have more buyers still than we have property listed. And what that does also is to help at best, at least stabilize, right? Kind of keep the housing prices stable to where we don't have a sharp decline in prices where you lose the equity in your home. So people are still building equity. So if you are in the market to buy and you've checked off all of those items that we talked about previously, then yeah, it's a good idea. Go ahead and buy. Okay. Another pro is entrance into becoming a real estate investor. So if you have hopes and dreamed of being a real estate investor, this is a great way to segue into being an investor. How? Okay, so you've already bought your house and you're thinking about buying another house that you want to live in. So you bought a starter house, your family's growing, or you feel like your income is increasing, you can afford a bigger house. Then you can just simply turn the current house that you're living in into an investor home. You can rent it out, okay? Mortgage companies will allow you to do that. It's called a conversion, right? So you're converting your house that you're living in from a house that you're living in, owner occupied, to a rental property. And that conversion is not going to cost you anything. It's just simply you listing your house for someone to rent it, and then you buying another house, right? It's just that simple. So the down payment that you typically would have to put down when you're buying an investment property, and those are flat out 20%. Okay, you have to put 20% down whenever you're buying an investment property. By you simply converting your current residence into an investment property and then buy another property at a 3% down payment rate, you're saving a substantial amount of money. So it's a great way to segue into being a real estate investor. And the last pro, there are lots of pros, but the last one I'm going to talk about today is flexibility in customizing your home. So you bought a house, you want to paint your house a certain color, you want to, tear down a wall to open up your kitchen, you want to build a pool. You have flexibility to do that whenever you're buying a house. Another thing is stability. So whenever I have a video that I uploaded breaking out the different types of interest rates that you can get when you're buying a house. If you haven't seen that video, you probably want to pause this one and watch that one. But whenever you're buying a house, we have what we call a fixed rate, an adjustable rate. But if you're buying a house and you're locked into what we call a 30-year fixed rate, then your principal and your interest payment is fixed for the life of the loan. Assuming you don't refinance, you don't sell, you just keep the house and that's the house you're going to retire in, and you continue to make your mortgage payment, your principal and your interest payment remains the same. Now there are varying factors, right? So you have property taxes, we have insurance, those typically can change. And if for instance you get your tax bill and it appears your house is assessed higher, therefore increasing your tax bill, there are ways by which you can negotiate that to bring that back down. There are things that you can do to kind of work around that to keep your mortgage payment where it needs to be. So you have stability in knowing that what your payment is what your payment. Chance of increasing your credit score. So think of a house as we already talked about it's a huge expense, right? The example that I gave was, say you bought a house, $100,000. $100,000 is a lot of money. When you're making that mortgage payment and you're making timely mortgage payments, if you give yourself 3 to 6 months, you would see a huge increase in your score, right? I've seen people that have gone up 40 points, 100 points, right? So it's very, very important that when you're buying a house, you make your mortgage payments on time every single month, because you get to benefit from that credit increase. Versus renting, where when you rent, they don't even report it on your credit whenever you rent, right? Now, there are companies that help report it, but typically your apartment complex or your landlord will not report that on your credit report. So your monthly timely rent payments that you make to your landlord, you're not getting any benefit of that on your credit profile. So whenever you buy, you do, and you make monthly timely payments, between 3 to 6 months, you will see a substantial increase in your credit score. So now let's talk about the cons. The cost. The cons of buying a house. So the first one being the cost. It's a huge expense. I just gave an example. If you're buying a $100,000 house, it can cost you at least $6,000 to secure that house, plus other costs as well. So it's very expensive. The commitment. Once you buy, it's hard to just unbuy, okay? It's not like a lease where you can break a lease. Once you buy, and if you change your mind, so you want to move somewhere else, then you probably have to list it, work with a realtor to help list the house and wait for someone to buy the house. You know, once you buy a house, it's a commitment. It's hard to undo that, okay? So those are one of the things you need to think about. Another thing you need to think about are your maintenance expenses. Anything breaks in that house, it's your responsibility. Your refrigerator breaks, your HVAC breaks, the air conditioning breaks. It will be your responsibility to make sure that is fixed. So that's a con. And then another one is the process of buying. It can typically take 30 or more days to buy a house, right? It's not just something that you can jump in within a week, you have your house. No, it's a long process. So now let's talk about the pros of renting. The first one is minimal expenses. It doesn't cost as much to rent. Typically, you can get an apartment or a property rented, first month's rent, and it can get you into a house. So if your rent is $1,500, you have to pay $1,500 to get in, plus your first month's rent. So it doesn't cost as much to rent a house. The next one is amenities, especially if you live in an apartment. Most apartments have amenities like your pool, your gym. All those comes with the house. They're not additional expenses. The third one is flexibility. You can move anytime. You can sign a 6-month lease. I'm right now in a 7-month lease because I just moved into a new area. So I signed a 7-month lease so I could get to know the area and know where I want to live, right? So that is a pro when you're renting. Now let's talk about the cons. You are not building wealth. Whenever you make your rent payment to your landlord, you are building the landlord's equity. Unfortunately, you're building wealth for that landlord. So you're not building wealth when you are renting a house. Another thing that you need to figure out is your increase in your housing expenses. So whenever you sign a lease with an apartment complex, or with a private landlord, and you sign a 1-month lease, you sign a 1-year lease or a 6-month lease, At the end of that lease, your rent is subject to increase, right? 9 times out of 10, there's going to be an increase in your rent. So whenever you sign a new lease, it comes with an additional rent increase. Another thing, another con is dealing with a property manager. When you sign a lease, you're signing you're giving the landlord rights to gain access to the property. They may want to do inspections to make sure you're keeping the house in the best way. They may also decide not to rent to you. I've seen that happen. That has happened to me. When my kids were much little, we moved from Denver, Colorado to North Carolina. We were living in a house for many years. My kids were still very young. So we didn't have issues with kids just being kids, running, jumping, and doing all of that, carrying on. Well, we moved from a house to an apartment, and we kept getting noise in the apartment. We were violating the noise ordinance to where they did not renew my lease. I had to move because of my kids. My kids were very young, and they were being kids. And that was an issue with neighbors, and neighbors reported to the landlord, and the landlord did not renew my lease. So that has happened. That can happen. So keep that in mind as well. So now we've talked about a lot. We've talked about the 4 things that you need to keep in mind or you need to be aware of whenever you are wanting to buy, or if you're trying to make a decision if renting is right for you. The first being your finances, the second being your credit score, the third being how long you're going to be living in the property. And so if you got value out of this video, please like this video, please share. If you are in the market to either buy or if you need someone to help you through the process of buying and you don't have a lender that you're working with, slide in my DMs and I can connect you with a reputable mortgage lender, mortgage broker to help you with the process of buying. Till next time, have a wonderful day. Bye-bye.